Okay. Welcome, everybody. Thrilled to have you all with us. We are honored to have our guest, Noah Rosenblatt, who I'm sure you all know from good old Urban Digs, join us for today. And, we're going to keep this relatively free form enough. I just want to kind of get from Noah his perspective on what's going on right now and what we might be able to, using his crystal ball that he always has with him in his pocket. I'm curious to know what he thinks will happen as we, hopefully reach the apex and then slowly come out of this. So, Noah, why don't you first tell us, obviously I think most everyone knows who you are, but just give a quick intro of yourself and tell us where you're quarantined and what's your day like.
So my name is Noah Rosenblatt. We basically founded Urban Digs and built that technology that you guys use. I'm a former trader in my previous life, a day trader, and I got into real estate and basically looked at the real estate market as a trade, and I wanted to build a system to track the trades kind of thing. So Urban Digs is really a reflection of me taking all the trading needs I wanted for real estate and making it a reality. So that's what Urban Digs is. So when this kind of situation happens, the trader in me and everything I've learned from, I've been trading since 1993, and I love it. I love the stock markets. I'm enamored by it, and I kind of get a little obsessed when it comes to that stuff. Yeah, even now, I've been trading. Yeah. So, can I share my screen? Is that okay, Sandy?
Yeah, please.
It'll look a little different, but let me show you guys. And Sandy, can you guys see this? I'll go to a different page here. Hold on a second. Okay. Could you guys see my screen?
Yep.
Okay, cool.
Yep.
So I just want to talk about something that's a little outside of real estate for a moment. I mean, what I'm seeing right now, it's weird. It's like a combination of 9/11 and the credit crisis. And what I mean by that is, like the fear and the shutdown, everything's shutting down on a personal level, on a business level, and the fear is kind of like after 9/11, but amplified by God knows how much. We don't know how long it's going to last for. But like after 9/11, if you recall, everything shut down, and there was fear out there. And I remember weeks and months after 9/11, they were evacuating new buildings every couple of weeks. The Chrysler building, and then this building, that building. So it lingered a little while. And it took a little while for business to get back, but it was different. So in that sense, this reminds me of that because, we've never experienced this before. I don't even know if the real estate market shut down after 9/11. I don't think they did.
No.
Okay, so this is unprecedented, right? So in one sense, it reminds me of that, but at a much more amplified level. Secondly, it reminds me of the credit crisis because, and I'm going to show you something on my screen here soon. It reminds me of the credit crisis because you got to look at the global economic machine as like a big bicycle, okay? And you got the two wheels, right? And you got a 10-speed gear. And all those gears, those 10-speed gears are different, gears in there, right? Well, that's like how the plumbing of the financial system works. And this is, a lot of people don't understand this. And this is what, if you understand and grasp this concept, you would have been able to see this in advance. And I'll show you how. So one of the gears is, the repo market, the repurchase market, short-term stuff. Another gear is the commercial paper market. Another gear is money market funds. Another gear is other short-term financing assets, treasuries, right? These are all little gears in the machines that make things work so that businesses can have payroll to pay people to do services, et cetera, et cetera. So when one of those gears shuts down, credit spreads widen. And that's what I had a whole discussion. And guys, I really, you should take a look at this. I have a YouTube video, all right, Urban Digs YouTube video here. And I'm putting all these videos, like we're posting content, 3-4 times a week now on different stuff. And this is where I'm going to continue to post content. But if you go back, because this was timeless, you go back a month ago, right here, watching credit spreads during stock sell-off. This was February 27th. I did this. So that was 26 days ago. 26 days ago. The red alert went up. And it was because of credit. So go watch this. I'm not going to tell you, go watch it, subscribe to the channel, watch this on your own time. But basically what it does is it looks at these credit spreads. And what you need to understand is when the credit markets get worried, and this is what we're worried about, the credit markets, because the stock markets follow the credit markets. So watch the stuff that the stocks follow, right? So the credit markets, when money gets rattled, it goes into U.S. Treasuries and U.S. dollars. All right, that's where money goes in times of safety, mostly U.S. dollars. So yields on Treasuries are going lower. Okay, I'm gonna try to put my thing. Yields on Treasuries are going lower. At the same time, yields for investment grade and high yield corporate debt gets riskier. Those yields go higher. So like when crap's about to hit the fan, you got the Treasury yields going lower and you got the investment grade yields going higher, and that spread widens. Now take a look at the chart. This is a chart that I follow every day. It updates at a lag. It's not real time, right? This is updated at a lag, like a 1 day lag. You know, close the business Friday, you're not getting an update till Tuesday kind of thing. But look at this. It's the Federal Reserve BAA. That's it. That's like the higher risk investment grade, right? Higher risk investment grade, corporate bond yields relative to Treasuries. It's a spread. And when that spread starts to widen and rise, this thing's going to rise. So I follow this every day. In addition to everything I'm doing at Urban Digs, the trader in me follows this kind of stuff because I'm managing my portfolio. Look what happened in February. Look, it's right around here. February 27th is when it really started busting out. Okay, February 27th. And that's when I did that video.
Mm-hmm.
And I said, watch this. And I said, if this continues to go, February 28th, February 29th, March 2nd, look, you can see where we're going up here. Look where it went. And I basically said, if it starts to go up, stocks are going to sell off. It's just that simple. So the S&P 500 on February 27th, when the alert started flashing, was at 3,300. Before it fell 30%. This was so again, I'm trying to teach you. This is like decades of me learning this for myself. No one taught me this kind of shit. I had to learn it for my fucking self, right? I'm trying to explain to you guys. This is what you want to do. Understand what drives the machine. This is why the Fed came in, and let me just explain what's going on. There's two types of stimulus we could do. We could do monetary stimulus, we could do fiscal stimulus, right? The Federal Reserve is monetary. Everything the Fed does is monetary. They took rates to zero, done. They can't do anything there. They're backstopping the engine, all those gears, the commercial paper markets, short-term money markets, treasury markets, corporate high yield, investment grade bond markets. They're backstopping that so that the banks could actually have liquidity right at the front lines to ultimately give hundreds and hundreds of millions, billions, hundreds of billions of dollars, trillions, hundreds of billions of dollars to investors, to businesses, right? So the Fed is doing all that to backstop that. The pace, the swiftness that the Fed and monetary policy happened was unprecedented. Even after 2008, it took, because in 2008, we didn't know what the hell was going on. Like, we thought we could piecemeal it and do little by little. And ultimately, you know, they had to bring the big guns in, right? So it took months, many, many months for them, and we got behind. This time it took weeks. So you got one good thing in that you got this backstop. They're going to basically buy everything. They're going to print everything. That's because this spread went out. That's it. Now, because this spread went out, now you got all the break. Now the bike is breaking down and it can't even move. Add into that an oil price war.
Mm-hmm.
Who the hell forecasted an oil price war? Nobody. In and of itself, the virus and the global shutdown and the effect that has on revenue and credit right here, in addition to the oil price war, in and of itself, those on their own are enough to cause a crisis.
Right.
We have them at the same time. No one's really talking about the fact that, like, you talk about black swans. You know, each one of these could be a black swan, quite frankly, but both come better together. They're an ultimate black swan. So we're in this position right now where you have massive monetary stimulus, which is a very good thing. They're trying to mitigate a credit event. Mm-hmm. They're trying to prevent a Lehman Brothers from failing. If a Lehman Brothers, if Boeing fails, if the car companies fail, if the airlines fail, if the hotels fail, job losses go skyward, what does that do to everything? How does the cascade effect happen? Once the dominoes start falling, you got to stop it from falling. So you got to put this barrier up before it reaches there. That's what the Fed did to mitigate a credit event. Does that mean that we're not going to have credit events? No. We may get out of this, with the Fed owning Boeing or hotels. Who knows what's going to happen? And like it's just no one can predict it. It's just unprecedented. But the Fed is doing unprecedented things, and on that level, it's going to backstop it. Now, on the fiscal side, this is the most important part. On the fiscal side, that's the government coming up with something to help people, right? And now they're trying to get it done, and that's to help businesses. You got a big problem here along the chain. It's not just about us with commissions. Think outside the box. If you can't pay your rent and you can't pay your bills, your landlord, your management company, or your owners, they're not getting their money. They're not paying their banks.
Mm-hmm.
Now you got the small businesses with the offices that no one's allowed to work out of. If they can't pay those office rents and those commercial, they can't pay those banks. You see how it all trickles up? So the losses here are staggering. And what the Fed did is basically saying, I'm going to basically buy all that shit. So that's what's going on. That's why they did that, is because of this cascade effect. Now you get the fiscal side, and the fiscal side is trying to say, all right, what can we do to bridge the gap? We don't know how long we're going to be down for. Are we down for 1 month, 2 months, 3 months? I'm in the camp because I think I'm in the camp that I think it's going to take 2-3 months, June, and that's like a hopeful scenario. I'm a realist. I'm not an alarmist. I think I'm a realist right here. I think it's going to take a month, 6 weeks or so, at least. We're 2 weeks in, maybe 6 weeks, another 4 or 5 weeks to contain this thing. I mean, we got to expect numbers to surge. I mean, testing is just going through the roof, so it's going to start. You're going to see it everywhere, right? We all know it. We're all in ordered isolation. When's the last time you heard of this? Everyone's in ordered isolation. So this, all right, anyone expecting this to get back to business as normal in a month? No. Get your expectations right. This is a multi-month thing. So I'm of the camp that in 6-7 weeks we contain it, and then it's going to take another 6-7 weeks because this thing has like they're talking like it has a 14-day, like right. It could live 14 days or something like that. Or even after you're cured of it, 14 days, you're still contagious. So there's that respread. I mean, I'm listening to Fauci. Fauci's, he looks like he's tired, but Fauci's the man. And I'm listening to everything I could think of is just focus on Fauci and that other woman, the medical woman, and listen to what these medical are saying. And the hope is that our scientists come up with a treatment and we get a containment, but everything's in lockdown. So and that's how it should be. Everyone should just not leave unless essential stuff for 14 days and let the hospitals do their thing, and help the people that need it. So we're in this period. It's going to be months. The question is very, very, very simple. Number one, how long until peak containment? Everyone is asking the same question. How long until those things go down? Now, the good news is if you look at China, if you can believe it, look at China numbers, way down. You look at Italy, even Italy, as bad as it is there, they're starting to go down.
The rate of acceleration is slowed. Yeah.
Right. And there's the second derivative, whatever they talk about right now. So that is something that's important. That basically says, all right, we could see it, right? But it's not time to get out of the woods or anything yet. So, I mean, in the meantime, we just got to, it's going to be volatile. It's going to be crazy. The second question is the duration of peak shutdown. There's 2 questions. So, like, if we get to that point of Italy where it's contained, don't think we're going back out next day. You know what I'm saying? Like, I mean, I don't think that's the most prudent thing to do, because the last thing we all want as brokers is this to last for 6 or 8 or 9 months, 12. That's the thing. If we fuck this up, sorry for language, if we mess this up and we started out bad, we started out with some policy problems. I'm not getting into politics. We started out with some problems. There was blame everywhere. Everywhere there was blame. But it seems like we're past it now. And it seems like they're starting to get all the right things without a couple of problems they still got to figure out. But Cuomo's nailing it. He's starting to really come through with some really good ideas. And I think we're starting to step up and realize this. And I think it's all going to happen at a very fast level. And that's the best thing you can hope for. The last thing we want is to be shut down for 6, 9, 12 months, 6 months.
Yep.
That's the last thing. So, here we are now adapting to a new business. And our business is virtual closings, virtual showing. I mean, I don't know how it's going to work out. And virtual closings is trying to be dealt with.
No, before we get into that, I have a question about this chart. I'm just curious.
Yeah.
Is there a correlation, or is it just purely kind of by happenstance that what we're seeing in the mortgage market interest rates going up seems to be paralleling this?
Yeah. So I'll explain what's going on. So you're getting into traders kind of stuff now. Okay. So what happens when credit blows out? And we've only said this twice in the last 11 years. We've said it in 2008, 2007, 2008 when it predicted it, and now we're saying it again. So this is not something like this move right here. is not a blowout. Like you gotta get rid of the false moves and look at that's why when we deviated up here, like see how we deviated, you can see how it's starting to move. This was a blowout, okay? And now here's what happens. It goes in stages, right? And what happened is it went from like moderate to severe to just panic really, really fast. And we fell 25+% in like the first 2.5, 3 weeks. And what's going on at that point is you have liquidations. That's all you get, liquidations, right? And you have pension funds, sovereign wealth funds, government funds, all these funds, large institutions with $50 billion of sell orders to do. And they can't, they got margin calls. We got redemptions, pension redemptions. People ask for their money back. You got to sell in that environment. So you have a choice. Are you selling the stuff that's down 40, 50, 60% in 2 weeks? You know, or are you going to sell the stuff that's up, like treasuries, like gold? So what happens is you're going to start to see some risk parity trades. Risk parity is if you're long, you know, you have some type of, and you think of problems coming, you get some risk parity by buying treasuries. So I'm long the market. I got long positions, but I got 20% in treasuries just as a precaution. If my stocks go down, my bonds go up, my government bonds, right? So it's a risk parity trade. When times of extreme credit stress and liquidity problems, you're going to have margin calls, liquidations, and redemptions. And that's going to cause risk parity trades to reverse because it's indiscriminate selling. They're selling what's worked to raise cash. And during that time, the US dollar is going to rise at the same time. So that's what happened. And it happened a few times last week. That's actually a signal in trader talk of capitulation starting to come in. And another sign, usually volatility spiking at that time. And usually that's a good time to start thinking the other way. Like, you know, start to nibbling on some buy sides that have been killed kind of thing. Yeah. Yesterday, another sign yesterday, volatility rises when the stock market falls. Okay. And if you go to my Twitter account, I mean, you know, I don't want to, you know, say this thing, but I'm talking about my Twitter account's like a live of me trading. Like that's why I put it separate. I don't promote it, you know, but I talked about it yesterday. I talked about it yesterday, how the market was going down. Look right here, yesterday. So weird to see volatility down today, falling as equities fall. Perhaps a green shoot for bottoming or something else. The UVXY was down 19%. The VIXY was down. These are volatility plays. And the S&P 500 was down 3.6%. You would expect those things to be up 20%. Instead, they were down. So like the market was selling off, but volatility was selling off with it. Why? Because someone was unwinding a major volatility position, betting that the market may bounce. It was a green shoot from a trader's perspective. These are signs, trader signs. The best thing I think you guys can do, because it's complicated stuff, and you know it takes a while to understand all this crap. The best thing to do is to simplify it and look at one chart.
Right.
And no, it's not. At this point, you missed it. You missed it at this point. If a good time to consider buying is when this starts falling back down. That's when the volatility is going down. This starts coming back down. As long as this is going downwards, it's better to hold stocks because stocks are going to be pressured to go to the upside. If this starts rising, it's not better to own stocks because the pressure is on the sell side. And you can see what happened. But you missed it. This is a credit alert. This is an alert in normal times when you're generally buying stock, which, you know, 10 years from now, maybe there'll be another moment, you know, because we're going to ultimately probably reflate out of this. But this is something that when you're, all right, when do I consider getting out of some of my positions I made a lot of money on? When credit starts blowing out. That's the answer to your question. So it's good to follow this. I mean, I've been following this 15 years, and this is the first time I'm actually able to actually take advantage of this knowledge.
So we know who to go to get loans from. It will be from you.
Yeah, I mean, it's only happened. Look at the 10-year. Look at the 10-year chart. It hasn't happened. Look at where we were in a little bit over here in 2016 with sell-off. Where can I go back further? That's gonna go max. All right, there we go. Here's the 2008 crisis right here. Look when it predicted it. 2007. 2007, November 2007. Look at rising right there. That, you know, if you were watching Urban Digs, I was talking about it back then. Like I started to learn about it back then. I didn't trade on it because I wasn't sure, you know. And then it's like, holy crap, this is what happened. You know, this is the thing to follow. Look at where we are. So it could get worse. Like, here's the thing. This is not a day trader's market, but if you're asking a day trader, which I am, to tell you what I see right now, very volatile, right? I think you got a relief rally coming out. We fell so much, and we have massive stimulus.
Right.
Massive. They're going to announce this is going to be 3, 4, 5 trillion there. And then the Fed's going to buy another 5. It's going to be 10 trillion by the time this is all done. This is going to be 10 trillion. In a year or two from now, you look at the Federal Reserve assets and liabilities, and the liabilities will be about $10 trillion because they're backstopping everything. They're going to buy everything: mortgages, corporate debt, treasuries, investment grade debt, commercial paper, money funds. They're buying everything to prevent a collapse.
Yeah. So I want to go back for a second though. On mortgage interest rates, where do you think? So we saw them bounce last week.
Yeah.
Up to about 5%. What I'm hearing from people from in the industry saying is that give it a week or 2 weeks and it's going to settle back down into the normal range. Is that what you think based on the charts that you're looking at, based on anything else? Do you think that that's likely?
First off, I don't know. Okay. I have an opinion on it.
Yeah.
But I don't know. Okay, so my opinion is that we're going to have some sort of relief rally. And what I'm looking for is that after this fiscal stimulus is announced, if we fall on that fiscal stimulus, I think we're going to fall a lot. If we rally on that fiscal stimulus, I'm getting out of my positions that I played for the bounce, and I'm going to look to buy treasuries and sell out and stay in cash again, because I think we're going to fall again. So I think there's more liquidations coming. I don't think that unwind has happened. I think it's going to take more weeks or months. And I don't think the pain of a full revenue shutdown has really been felt yet. We're in the acute part of it. It's just 3, 4 weeks old, 5 weeks old. So it's this battle against stimulus versus the shutdown. So I think that, yes, I think the rates are going to go back down because I think the market's going to have another leg down. I just think we might have a relief rally, a pretty sharp relief rally before that happens. And you're seeing part of it today. So
cool. What would you, well, so a couple different questions. One, I'm just curious, I mean, you're trapped at home just like the rest of us. What sort of things are you doing for your business right now to prepare for whatever does come down the road?
So I'm in a slightly different, I'm in the technology business now, right? But we're busier. We're being asked by a lot of people what's going on. My voice is, I'm losing my voice because I've been doing so many podcasts and phone interviews. Never in my life, you know, we got 3 we're in the New York Times, Forbes, Business Journal in the last 3 days. Wow. Like, and the Real Deal. Like, I've never seen more of this ever happen. That tells me something. People are looking for insights, right? And I'm honored that people are coming to us to rely on them. But I think that you guys should take advantage of that model that seems to be working. And I would take this opportunity to do a couple of things. I would take this opportunity to, first off, get very used to virtual technology. Incorporate virtual technology in your consulting with your clients. Okay, guys, one site I like, let me go to it. Okay, useloom.com. Okay, useloom.com. Let me log out. So I use it all the time. Yes, or it's called loom.com. I guess they changed it. It used to be called useloom, finally. Like the Facebook, looming the. So loom.com. And this is just a plugin. A free plugin. You know, you click it and you get a little plugin right over here. You see this little red thing on top of here? And I click it and it signs it. It uses my video and it allows me, it's a screen share with my video. And I get to talk and communicate and say, hey, Mr. Joe Johnson, you know, I just want to show you what I see is going on here. And I want to give you a little personal touch. Here's a video. Here's me looking at my analytics. And you can use whatever website you want. You can be on Urban Digs. You can be on whatever. But I use it all the time with Urban Digs. So I go to Urban Digs and I go to my chart room, you know, and I'll sit there and I'll consult. And I'll tell my clients what I'm looking for. And I'll reinforce the fact that I am the person that you're going to rely on to navigate through this crisis. Through virtual, engaging, one-on-one content. You could do weekly updates once a week, every Friday. Find something that fits your niche. You know, do a weekly look, do a chart, whatever. Just take a look and show the changes over time. So people have a relative understanding. Oh, it was here, and now it's here, and now it's here, and now it's here. And you're kind of doing, I'm going to do this every Friday. I'm going to do it every Wednesday. You know, and I look forward to giving you guys updates. And become the place for consultant, for wisdom, for knowledge.
Mm-hmm.
Because at some point, we're going to get out of this. And like, you want to be relied upon as that person. I mean, because John and I are trying to build a reputation of being, the market insights data source people.
Mm-hmm.
We're going back to the B2B play. Urban Digs in 3 months is going to be a completely different website with the video content and tools for you to do all your stuff. But we're going away from like search and collaboration and more into market insights and content for you guys. Search and collaboration will be there. But I've learned something like, damn, that was the right call, because I could see it now. So this is an uncertain time. And in uncertain times, your clients are going to look to someone for some certainty, for some voice of reason.
Mm-hmm.
That should be you. Like, use this time to engage your clients and again, this is not about selling.
No, exactly.
It's about, here's what's going on. Here's how I see it. Try not to predict anything. Give opinions, but try not to predict anything, because marketing go against you. But like, here's what I see. Here's what's going on. Here's what I'm seeing in my business. I want to share some insights, and here's some data, and I'm going to keep track of this and just show you guys the changes as we go. And at the end of the day, you'll get out of it, and they'll rely upon you. And not only that, but your buyers are going to be pent up.
Yeah. That's the biggest thing that I've been talking to a couple of different people. There's going to be so much built up pressure in the system.
Oh my God. Yeah.
That I think at least that first month of relief buying will be intense. We'll then see, and I'm curious to see if you agree with this, I think after that, we'll probably see supply really kind of go up and the absorption rate, be problematic for a few months.
Yeah, it'll take a lag, because whatever deals are happening right now, we're not going to see that until about July, August, September. So deals signed in March, April, May probably won't be until June, more like July, August, September,
Mm-hmm.
right? That lag, just how it works. So we got to be looking out for the sales data back in Q3 at that point, end of Q2 and Q3. I got the monthly data, so that lets you do it. But I think that's when you're going to see that little boop straight down, and it'll be down there for a few months, and then it's going to come back up. I'm really curious to see what that is, because I think it's going to be a little later, Sandy, because the deals that are signed right now, and there's about 525 of them so far this month. Not bad. But most of those deals are were signed previously. So if you take the first 2 weeks, and you take the last 2 weeks of March, 430 of those 500 and whatever were the first 2 weeks, and the last 2 weeks are basically nothing. So I don't expect that to rise much more.
Yeah. At the same time, I'll tell you, we signed 5 contracts last week. That's probably the end, but we had 5 last week.
At least you got the 5 done. Yeah.
Yeah. Let me open up for questions. If there's anybody that wants to type into the chat, please feel free. And while you're doing that, I'm just curious to know, what's the first thing you're going to do when this lifts? What's going to be like your present to yourself when you can go back out again?
Is that for me?
Yeah, that's for you.
I want to go to Jamaica.
There you go.
I want to go to some exotic place. I want to go to the beach.
Well, as someone who has not been on vacation for a very long time,
I've been on vacation for a long time, and I want some dirty bananas or whatever those drinks are called on the beach. I mean, someone spraying me with a little bottle, what I'm saying, every 20 minutes.
Feeding you grapes.
Yeah.
Just touching you.
Coconuts, grapes, and they have some Jamaican food or something. I might even enjoy one of the local things that are growing in the backyard over there, but I get through this.
Okay. I don't see any questions yet. Let's see if anybody, this is being recorded, yes. And we will be posting this. All right, so thank you, Noah. I mean, we greatly appreciate this. This was quite a brain dump. And I think I'm gonna have to go back and watch it again just to see if I can understand half the stuff.
It took me 20 years to figure it out, so I understand. But I try to simplify as much as I possibly could.
You did great. Thank you so much, and we look forward to chatting with you soon.
Great, thanks, guys. I wish everybody to stay safe and well, and I look forward to getting out of this.
See ya.
Bye, guys.